Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we'll break down the latest consumer sentiment data amid a volatile week for investors amid worries about growing recession risks. Plus, as the U.S.-China trade war escalates yet again, we'll look at global investment opportunities providing safety for investors. And with earnings season shifting into full gear, we'll bring you the takeaways and what the C-suite is saying about forward guidance. Half an hour into the start of your U.S. trade, let's get you a check on the markets. Taking a look at the major averages. You've got some green on your screen here. Your S&P 500 up about 0.1%. Your tech-heavy NASDAQ up just about 0.4%, paring back some of the gains that we saw earlier in the trade. But as to be expected in a week like this, the star is the bond market, and we especially see this in your 10-year yield hitting its record high in terms of its yield since February. And it's actually higher now than it was before the White House capitulated on tariffs to the bond market and announced that 90-day pause for negotiations on tariffs. What will the White House do now that 10-year yields and the broader yield curve is continuing to move to the upside amid a sell-off in the bond market? We will continue to cover that throughout our programming, but let's take a look here at Bitcoin to wrap up for the moment. You got Bitcoin up just about 2.4%, steadily above that 82,000 line for Bitcoin this week. And finally, University of Michigan consumer sentiment is crossing the wire here. I want to get you those numbers. Michigan, 5 to 10-year inflation expectations rising to 4.4% versus the expectation here of 4.1%. 1-year inflation also coming in hot. The expectation for 5.2%. The actual number coming in at 6.7%. You can see as I'm reading the numbers, the S&P 500 flipping negative here. And also want to mention another stat that we were seeing in the University of Michigan sentiment data, the survey indicating a 53.8% level, coming in below that at 50.8. And again, University of Michigan expectations coming in a little bit soft as well. Want to get you that 5 to 10-year inflation number also coming in just a bit hot at 4.4% above the estimate, which was 4.3% here. So looking like investors and consumers, I should say, for consumer sentiment data are anticipating a little bit more inflation to come than the survey had estimated. You've also got your NASDAQ flipping between red and green this morning, flipping negative just for a moment here off the back of these numbers. From consumer sentiment to corporate sentiment, I do want to bring in Yahoo Finance Executive Editor Brian Sozzi. He's going to join me for the hour here. Sozzi, really interesting to see this consumer sentiment data turning negative here, at least in the market reaction. But I know that consumer sentiment is sort of what drives corporate earnings. And then you spend so much time talking to those corporate CEOs about how their sentiment is in this moment. What are they telling you?
Well, I'm not surprised. Disappointing consumer sentiment. I think what we're hearing from CEOs reflects this downbeat mood with U.S. consumers. BNY Mellon CEO company came out this morning, pretty solid earnings results for them. Got hopped on the media call. Really got an interesting quote from BNY CEO Robin Vince telling me that it's this period of uncertainty. It's where businesses and consumers might lose their mojo, quote mojo, I should say, that Robin saying that. You see that on the screen right there. He makes a good point, and I think that quote right there really underscores what you're seeing in the market, these big down days, but you get signs that might see improved confidence, stocks tick back up. But then I got off that call, hopped on the media call with Jamie Dimon and his CFO, Jeremy Barnum, after their earnings this morning. I asked Jamie, how are things different now, Madison, compared to other periods of crisis during his very long career? He said he's seen people pull back, not only people, middle type businesses, middle-sized businesses, large-sized businesses. So there's Jamie Dimon's quote to Yahoo Finance here. So everything that the market has been trying to sniff out, Madison, with these big down days, we're starting to hear it from CEOs, and not just any CEOs. These are some of the biggest leaders in this country, leading some of the world's biggest banks. Now, I will say this, though. JP Morgan not seeing consumer spending weakness in April, important point there. But still, when you hear Jamie Dimon saying companies are pulling back on investment, that's a red flag. Bigger picture, here's what CEOs are telling me more broadly, and I think it really aligns what I heard from Jamie Dimon and Robin Vince this morning. You see a lot of CEOs that I talked to are frustrated that they do not have a direct line not only to the president, but a couple rungs down to get their message across. They're still dealing, I think, with a lot of advocates in D.C. that may or may not have their best interests in heart. Second up, trade uncertainty beginning to weigh on sales. I think you got that vibe from Jamie Dimon's comment to us this morning. Price increases will be coming. Been talking to a lot of apparel CEOs. The interesting thing to watch is they're not yet ready to drop the hammer, Madison, with really big 10 to 20% price increases. Those price increases might be surgical until we get more clarity on tariff policy from the administration. And last but not least here, long-term investments are being discussed, not scrapped. If you are still planning to build a plant this year, next year, those plans are continuing. It's more of a function, well, if you're going to build a plant 5 years from now in another country, do you continue to do that? That is what's up in the air. That's certainly what's up in the air for those corporate executives who I know you are on the pulse of, Sozzi. So thank you so much for bringing us that reporting. I'm so excited to have you for the entire hour. It's an honor to be here. It's going to be so great. Love it. Lots to talk about, especially amid these consumer inflation expectations really ticking up, indicative of concerns about the broader economy amid those tariff concerns. But let's turn now to how global markets are responding to the trade war. It's been a roller coaster week for European and Asian stocks alongside the U.S. as investors seek clarity around President Trump's trade policies. So where can they find opportunity? For that, we have Jeffrey Kleintop. He is the Chief Global Investment Strategist over at Charles Schwab. Jeffrey, great to speak with you here. Even U.S. consumers seem to be losing faith in the United States, both in terms of their investments, fleeing the bond market at a record pace, and then in terms of their concern about inflation expectations. Where should investors be looking if they want to flee the U.S. right now?
You know, Europe stands out to me. Obviously, the risk of recession is rising in the U.S., but in Europe, it's much less so. Europe's economic exposure to U.S. exports is relatively small. EU goods exports to the U.S. account for only about 3.5% of EU GDP. And so the hit from those tariffs, were they reintroduced in 90 days, might shave maybe 0.5% or so off of GDP. But look, already you've got Germany, which is Europe's largest economy, approving a big defense spending and public infrastructure package amounting to 2.5% of German GDP. That's a big offset. And you've got further spending, a more of a proposal for EU-wide defense spending, more rate cuts from the European Central Bank, cutting the policy rate below 2%. All that fiscal and monetary stimulus may deliver a sizable boost to growth. Remember, Europe's coming out of 2 years of a rolling recession, so there's more growth momentum there, potentially offsetting any drag from exports. And Europe's stock market's reflecting this. It's outperforming the S&P 500 by 18 percentage points. Jeffrey, good to see you here, but isn't Europe really exposed to what could be a very dramatic slowdown in China? Possibly. China is a bigger end market than the U.S., but here's what's going on in China. China's got 3 different budgets, but if you combine all of them, you're talking about deficit spending this year of 11% of GDP in China. We've never seen that before. If they follow through, and China has overpromised and underdelivered before, but if they follow through on that level of support to consumer spending within China, the 40 to 50% of China's economy tied to consumer spending could boom, even if the roughly 3% of GDP of direct exports to the U.S. really slumps dramatically. So I think China could actually see domestic momentum economically really improve this year. That could be great news for Europe. And what does that tell you, Jeffrey, just about the state of play when it comes to all of these global trading partners sort of reallocating who they are allies with? We obviously had the Spanish Prime Minister meeting with Xi Jinping. She is heading to South Africa next week. To what extent do you anticipate a reorder of global trade relationships impacting investment opportunities? That certainly seems to be underway. As a matter of fact, there's even some talk about examining those electric vehicle tariffs on and quotas on China as they come into the EU. So really a lot of realignment taking place perhaps here as the rest of the world sort of shores up their trading partners as they're worried more about the U.S. And yeah, that could mean different things. Latin America, for example, much more exposed to China than it is to the U.S. Brazil is an economy that exports a lot more to China as well. So we're seeing maybe a reordering of world trade, focusing a bit more on Asia, China in particular. Jeffrey, it's not lost to me, your founder, Charles Schwab, visited the Trump administration, I believe this week, and I was reminded of how your company has been a champion for the average investor out there for many, many years, in part by Mr. Schwab's efforts. If someone had $1 million in the market today, what do you tell them? First, panic's not an investment strategy. I mean, hopefully they have a diversified portfolio, but if they haven't, if they've been focused on, let's say, the US tech or AI focused stocks, the Mag 7 for the last couple of years, it's not too late to consider international investments in their portfolio from an equity perspective, bonds in their portfolio from a fixed income perspective. I know they're suffering today, but they've offered a really great buffer to a really US focused, tech focused concentration of the last couple of years. So think about diversification. Not only has it paid off greatly so far this year, but I think it'll continue to do so. And that's why we continue to preach a balanced asset allocation approach to investing and not trying to pick the hot stocks.
And Jeffrey, are bonds still safe in this environment?
You know, yields may creep a little bit higher, but I think yields are now high enough to offer a bit of a buffer there. So if you look back to, around the follow-up after the pandemic, that surge in inflation, yields weren't high enough to offer a buffer to the decline in price. Now I think it is. So yes, I think bonds can still offer some defense here to a portfolio. I keep those durations short, but we think bonds can still provide some safety in a portfolio.
Jeffrey, I want to get your take on a headline that's just crossing the wires right now. China mulling allowing Western market makers in its ETF sector. Curious from your perspective, if China were to try and lure in American investors with some opportunities like this, how disruptive could that be?
Perhaps. I mean, China has made some steps towards opening up their financial markets. The financial markets in China are not very sophisticated, and investors there, which have more assets, want to be able to invest outside of China. They're looking for opportunities that are a bit more sophisticated than what's being offered to them there. So this has been a slow progress. It's good to see that continuing, but I wouldn't expect anything to change overnight. China moves fairly slowly on these things.
All right, Jeffrey, thank you so much for the great overview. Appreciate it.
Thanks for having me.
Coming up, Constellation Brands expecting a big hit from tariff. CEO Bill Newlands joins us next with the outlook for the company. Stick around.
We are closing out a trading week that saw some of the biggest gains and losses since the pandemic. I'm Jared Blickery, host of Stocks in Translation. Let's put this volatility this week in context. So first, I just want to show you what the returns have actually been over the last 6 days, ending Thursday, so yesterday. And I have those in green bars. So going back to last Thursday, we have a down move of almost 5%, then down 6%. Wait a few days, and then suddenly we're up at 9.5%, and then Thursday we were down 3.5%. Also in these little white dots here, I have the percentage of stocks that have closed in the green for the S&P 500. So you're going to notice that this move, that these numbers go from very low to very high to very low very quickly. So 13% means 87% of stocks went down that day. 9% means 91% went down. And then on that huge update, 93% of stocks were in the green. And then once again, yesterday, 89% to the downside. So this just tells you the incredible vicissitudes that we're having in the market. Now let's get to volatility. We have two different forms, and I want to start with implied volatility. This measures the market expectations of a stock or option's future price swings, and this is what we measure with the VIX. But what I'm going to show you next is realized volatility. This is measuring how much a stock or options price actually moved over a period in the past. So here I have the 4-week average of the weekly range here going all the way back to 1980, and right now we're at about 7%. So stocks have moved 7% this week. And if you look at that on a historical basis, we've been quite a bit higher a few times. And you can see that in the pandemic. You can see that in the global financial crisis. You can see that in the 87 crash. And we've also stayed at these levels for some persistence periods of time, like in the early 2000s, the dot-com bust and crash. That was over a period of about 3 years. So these things can be ongoing even if the magnitude doesn't necessarily rise. But so far, this has been a very quick trip to the downside. And I just wanted to further put this in context, going all the way back to the Great Depression. This shows the S&P 500 returns that are under 3% and over 3%. And you can see the huge clustering in the Great Depression and World War II of those huge moves. And we haven't seen anything like that since. In fact, we had several decades of relatively non-volatile markets. But then things picked up again. We got some movement in the 80s. We got that dot-com crash. crash, we got the global financial crisis, and then we got the pandemic, which we're seeing right here. And what's interesting about the most recent moves is we've seen a day here that eclipses what we saw in the pandemic, but to the downside, we haven't seen those dates just yet. So the level I'm watching in the S&P 500 is 4,800. Watch that. If it cracks, I think we'll see some of those big down days rival what we've seen in the pandemic. And if not, well, perhaps it tripped back up to record highs again, although it's not necessarily a fait accompli, and it doesn't have to happen on any time schedule. Tune into Stocks in Translation for more jargon-busting deep dives, new episodes on Tuesdays and Thursdays, Yahoo Finance's website, or wherever you find your podcasts.
All right, Jared, thank you so much. Let's take a look at Constellation Brands. The stock under a bit of pressure this morning after issuing a weaker than expected outlook for fiscal 2026. The Modelo maker expecting to take a hit from President Trump's tariff policies. Joining us now, Bill Newlands, Constellation Brands CEO. Bill, great to have you on this morning. Talk to me about the 90-day pause that happened this week, because obviously the stock market was euphoric about it before a little bit of a give back. How are you navigating the implications of that 90-day pause and just the lack of clarity about what that's going to mean for your business? What are you doing right now?
Well, fortunately, we've been USMCA compliant from back in the first Trump administration. So we've had relatively little involvement relative to that. Our main involvement has been around the whole aluminum tariff. And then you have, obviously, the tariffs related to our wine business from both Italy and from New Zealand. We're trying to keep our focus on what we can control, and we don't control that issue. So our focus has been, let's continue to execute against our business. Our brand health remains world-class, particularly for our beer business, even though there's significant challenges with the Hispanic consumer. So we're really focusing our attention on doing what we can and controlling what we can.
Bill, good to see you as always. You mentioned the challenges on the Hispanic consumer. Is that because of this administration's policy towards immigration?
Well, the consumer's concerned about a number of things. You know, we do a fair amount of research, Brian, as you would expect, on how the consumer sentiment is. And there's several areas. They're concerned about the pricing, costs of things, inflation. They're concerned about immigration, particularly consumers that have had friends or family who've been involved with issues around immigration. And how that's translating is that people are spending less. They're out less in restaurants. They're spending less on consumer goods and consumables. Fortunately, beer is pretty far down the list, but there's an overall concern in that community, less social gatherings. You know, people are getting together less. Those are beer moments. So for us, that creates a bit of a challenge that many of those scenarios and situations that normally would be consuming of our products are just not happening at the rate they have been.
To that end, Bill, you've spent, the company has spent billions the past few years building up their production capacity in Mexico. I believe you'll spend another, $2 billion building out a plant in Veracruz over the next 12 months. I think this administration would say, Bill, well, why didn't Bill Newlands invest those billions in the U.S. in making beer? Can you build a beer-making plant in the U.S. and make profitable beer doing so?
I think there's a couple of things, Brian, you have to keep in mind. First of all, while we're an American company, we're invested in Mexico because we are selling authentic Mexican brands. These are not brands in the same way that you're not making champagne in the United States, or you're not making tequila in the United States, or you're not making New Zealand Sauvignon Blanc in the United States. We're not going to be making Mexican beer in the United States. But don't forget, we have invested $1 billion a year for the last several years in the United States supporting our business. We support thousands and hundreds of thousands of jobs in the U.S. through Teamsters, through our distributors, through our retail network. Because, as you know, we've been one of the real growing companies in the CPG sector. Therefore, we do a lot in this particular market to support our business and to support the local economies.
Bill, I've been covering your company, I think, for 10 years. You and I have talked a lot. I've never hopped onto your earnings call and heard an analyst ask about the relationship with the Teamsters. Help us understand, are the Teamsters trying to pit American beer companies versus companies that produce in Mexico like yours? And what will that back and forth look like this summer? And do you think it impacts a company like yours?
I think the Teamster question was more of a localized issue. What probably wasn't recognized, although I do believe the National Teamsters now very much understand we brought a lot of new jobs to this country. Our distributors that carry our business have seen significant upticks in their business because of us, and many of those are Teamster jobs. So I think there's a lot of learning to be done about how companies like ours operate and the amount of business that we bring into the U.S. That doesn't even include the fact that many of our inputs, grains, corn, barley, come from the Mountain West of the U.S. and are then made into beer in Mexico. So we're really a company that understands both sides of the border. But I think that particular issue was very localized, and I think the overall national Teamsters recognize we brought a lot of jobs to this market.
No, good point, Bill. And seemingly every day I go into my Instagram account, Bill, and I see Hulk Hogan out there. He's out there hawking real American beer. Do you think that's what we're headed to? I mean, it's a U.S. versus rest of the world type of thing in the consumer packaged goods industry.
I think a couple of important things. Corona is the best loved beer in the United States, and Modelo is the #1 beer by dollars in the U.S. So our beers are very well received by U.S. consumers, and there's no beer of size that has the growth profile that Pacifico's had. It was up 16% last year. So we have brands that are very well received by U.S. consumers, and I hope it doesn't go into that sort of an angle because our brands have been very well received here in this country.
Bill, my sources tell me that they're shocked that more CEOs aren't talking about the negative impact of immigration policy on their bottom line. So I'm interested that you brought that up. And I wonder, in a hypothetical scenario where you have a line into the White House, which policy are you bringing up that you would like changed? Tariffs or immigration?
I think consistency is something that we're anxious to see. It's sometimes difficult to plan when you see varying things that occur over time. It also would be very good, in our judgment, to calm the Hispanic consumer down. Most people who are in this country legally have no issue, but there's a fair amount of fear. And I think it's important that consumers, for our perspective, that consumers are comfortable and that they're comfortable going out and shopping. As I said earlier, that's something they've cut back on significantly, going out to social gatherings, going to restaurants. And certainly for our business, those are occasions that are important for beer. And it would be important that those consumers get more comfortable.
And Bill, I talked to a lot of leaders that occupy your seat, the CEO seat, and they tell me they've never managed through something like this before. They've never seen it before. It's chaos. It's impacting how they're thinking about their longer term operations. Have you had to manage through a situation like this before? And what has the past month been like for you?
I'd say the only thing that's been close to it was the initial COVID timeframe. Obviously, people changed their behavior quite a bit during COVID. And you're seeing some similar, although it plays out differently, but changes in consumer behavior that are sort of unprecedented. We've decided very carefully we're going to stay focused on what we can control because some of the peripheral elements you just can't control. So we're trying hard. We want to win in the market. We're going to continue to support our brands at unprecedented levels. Fortunately, our brand health is good. So as the consumer gets more comfortable and comes around, we're going to be in a great position to continue the growth profile that we've had for the last several years.
All right, Bill, thank you so much for making time for Yahoo Finance. And of course, thanks to our Brian Sozzi for bringing us the conversation. Coming up, Meta facing a major lawsuit in the European Union. That and more when we come back. It's now time for some of today's trending tickers. We're watching concerns for NVIDIA GPU sales, some defensive plays, and Logitech withdrawing its 2026 outlook. Let's get into it. First up, shares of NVIDIA ticking higher about an hour into your trading day, up a little over 0.3% right now. Citi analysts cutting their NVIDIA price target to $150, maintaining a buy rating. Citi also revising their estimates for GPU sales down by 3% for 2025 and 2026. Analysts saying the trade war could put enterprise AI projects and hyperscaler CapEx at risk. Joining me to discuss for a moment, Brian Sozzi is still here with us. And Brian, I think what's interesting, at least when I talk to my sources at the likes of Amazon, for example, they have said there has been no downturn in demand for AI, for chips. And it's interesting to hear this call coming out for NVIDIA on the back of that.
Why this call sticks with me, Madison, is because it is really the first estimate cuts or downgrade I have seen on NVIDIA really at all, even since its last earnings report, because the company was heavily defended after that earnings report. So it's an immediate flag for me, has me thinking, is demand starting to slow down in NVIDIA? Also keep in mind, you go to the ticker page on Yahoo Finance for NVIDIA, click on analysis, you can see the street remains very bullish. So if this is the first sign to come, you theoretically could see a leg down, or another leg down in NVIDIA as the street cuts estimates and potentially cuts this rating. So I give this analyst a credit. He's the first, but he may not be the last.
He certainly may not, but let's talk about some other calls this morning. Jefferies out this morning with some of their top plays for tariffs uncertainty, with what they say is a balance of risk and safety for the unsteady market. The note includes a range of consumer-facing names ranging from Uber to Exxon and McDonald's. And Sozzi, I know you had an interesting response to some of these calls.
I don't really agree on most of them. There we go. I don't agree that Uber is a recession-resistant play. I just don't see it. Now, they are bullish on Netflix. I get it. I don't think the economy is going to come to a point where we're cutting our Netflix subscriptions. One I agree with McDonald's as consumers trade down. McDonald's historically during recessions does pretty well financially, and I believe stock price too as well. But again, I think this note, I appreciate what Jefferies is trying to do here. I look at Exxon. I mean, oil prices have plunged. Not sure how Exxon is going to do amazing things come earnings season with oil prices off the highs. So I'm poking a couple pins in this one.
Yeah, price of oil per barrel right now doesn't even cover the cost of production. So an interesting call.
That's a stocks and translation right there.
There you go.
Maddie,
I'll pitch it for next week. We'll see.
Very good, very good.
All right, finally, Logitech withdrawing its fiscal year 2026 outlook due to uncertainty. That's a sentence you're going to be hearing a lot from us this quarter. Logitech reaffirming its outlook for fiscal year 2025, which did end on March 31st. The company, which produces computer accessories and software, just the latest to withdraw its forward guidance following Delta Airlines and also Walmart. Sozzi, a tune we're going to keep playing.
You want to know how old I am, Madison? I remember the first camera that I had was like this circular ball from Logitech. It went on like my compact Presario. I mean, this thing was awesome. But why this bothers me from Logitech is because 40% of their production comes from one plant out in China. They have exposure to Vietnam, but I think this is the first sign of weakness in the computer, not only the component parts, but also computer makers. It's an HP, it's a Dell.
Right.
So there's more than me. This is not just a Logitech thing. All these companies rely on China, Vietnam, Malaysia for parts. So if Logitech is warning, best believe you could see pressure on these other companies.
And also for our audience, you can scan the QR code here to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Well, on Monday, Meta is heading to a Washington, D.C. court to face a trial against the federal government that claims the company illegally dominated the social media market. Meta is the second tech giant to face trial in the government's recent string of big tech antitrust cases. And so far, CEO Mark Zuckerberg appears to have failed in efforts to persuade President Trump to call off the case. Here with what's at stake, Alexis Keenan, Yahoo Finance legal reporter. Alexis, thanks for being here. Walk us through what we can expect.
Yeah, so the stakes are really high here for Meta, and it's particularly because the FTC is asking for a judge in this case in Washington, D.C. to cause it to get rid of Instagram, which it purchased in 2012, and WhatsApp in 2014, that the FTC approved after merger reviews at those times. Now, the FTC, for its part, says that Facebook bought the apps in a buy or bury scheme, is what they call it, to illegally block competition rather than competing with social media apps that were on the rise. They say that the market at issue here is the personal social networking services market, and that Facebook, Meta, other apps they purchased included a market intelligence software tracking company that would track users across the internet called Onavo. It's since shuttered. Also, Google, remember, once was interested in social media too. They had an app called Glance, or Glance, I'm not exactly sure how it's pronounced. All of those purchases, the FTC says, was a part of a scheme to not have to compete in this market. Now, Meta, for its part, they say that it's no monopolist at all. They say that the FTC's defined market here is really off base. Why? They say, well, it leaves out things like TikTok, it leaves out X, it leaves out YouTube, it leaves out LinkedIn. all of those, Meta says, are competitors in this market. A spokesperson for the company said the evidence at trial will show that what every 17-year-old in the world knows. They say Instagram, Facebook, and WhatsApp all compete. They compete with Chinese-owned TikTok, YouTube, X, even iMessage. They throw an iMessage in there, and many others. Meta says the commission's action, they say, sends a message that no deal is truly ever final, and referencing those approvals from the past. They say regulators should support American innovation rather than break up a great American company and further advantage China on critical issues like AI. Now, if you take a look at the social media landscape, Facebook is still the front runner. They are still drawing the most U.S. social monthly active daily users, as well as daily active users. So they're commanding most of the ad revenue in this space. But Instagram is a huge revenue driver for Meta in 2025 this year. They're expected to make up about 50%, even more than 50% of Meta's U.S. ad revenue for the year, approximately $32 billion there. So if the company were to have to divest Instagram, it's going to be a real problem for Meta going forward. So certainly they're going to dig in their heels on Monday when the trial begins with opening statements.
All right, Alexis, thanks so much for giving us the preview. And of course, we'll be talking to you on Monday as well. We're going to have all your markets action ahead, so stick around. You're watching Catalysts. The dollar and bonds selling off as U.S. assets begin to lose their safe haven status in the escalating trade war between the U.S. and China. Here to discuss the outlook for the currency market, we have Mark Chandler. He is Bannockburn Global Forex Chief Market Strategist. Thank you so much for being here with us, Mark. I want to talk about the degree to which the sell-off in bonds in the U.S. dollar is impacting your view of the U.S. I've seen some notes, some sources joking and some being serious with me that the United States is heading towards an emerging market status. Do you think that the sell-off in bonds in the U.S. dollar is that severe?
I do think it's severe. I think that this talk about emerging market is meant as an insult, and I don't really know what it really means. Does it mean that our per capita GDP is falling? No. Does it mean that, what does it really mean? And I think that the real concern, I think, is that we do know that Canadian and Europeans consumers are boycotting U.S. goods. We also know that the travel plans to the U.S., those bookings have fallen sharply. What people are concerned about is that maybe we're seeing a capital strike against the U.S., where large pools of capital are selling U.S. assets and taking their money home. And this is, to me, the problem with this is two things. One is that we don't really have any hard data on capital flows that are in real time. And secondly, I think that the political climate is such in the U.S. where it's almost like a knee-jerk reaction to blame foreigners for what ultimately is a U.S. problem. So, for example, in the U.S. Treasury bond market, it looks to me, and apparently other people, that real pressure is coming from the unwinding of these basis trades, which is just a complicated financial speak, really, for this trade between Treasury cash bonds and the futures market. And this is done by large pools of capital like hedge funds.
What trade is working really right now in the FX market, working really well, and why do you think that's the case?
Well, I'd say the two strongest currencies have been the Japanese yen and the Swiss franc. And I think that those are the strong ones because I think, again, when we as individuals, retail investors, we buy a stock, we want that asset to go up. But when these large pools of money, when they really make these decisions, it's really about OPM, using other people's money to basically borrow the yen, borrow the Swiss franc, and use those. But borrowing means it's partly selling. And you're short, so you're using those proceeds to buy higher yielding asset, like U.S. Treasuries or U.S. stocks. And as those assets that you bought invariably go south or go against you, you have to buy back the funding currency. The Swiss franc and the Japanese yen are very low yielding. In fact, the Swiss have 25 basis point overnight money. And that I think is the primary cause of what's going on. It's not so much safe haven. It's really the unwinding of these structured funding trades, again, by these large pools of capital.
So if it's just an unwind, I wonder how that ties into the path forward for the dollar, given that we don't know exactly what the Federal Reserve is going to do next. Boston Fed Susan Collins spoke earlier with our reporter Jennifer Schomburger about a potential rate cut.
you've said that you need to see inflation start to come down before you would normalize policy. The markets are factoring in a rate cut in June. Too soon?
Yep. So what I would say is I think we're well positioned. We need to look at both sides of the mandate. I would be looking for more confidence that we were back on that disinflation trajectory, of course, unless we are in a more adverse context. Not my baseline. Again, there is quite a bit of strength in some of the underlying fundamentals of the economy, and policy is well positioned to react as appropriate.
So Susan Collins alluding to the idea that June might be too soon for a rate cut. How could that impact the U.S. dollar?
Well, I think that I put it this way, that the market, I think, is in a position where, we just had softer than expected CPI this week, softer than expected PPI, and yet the 10-year yield is making new highs above 450. And so I think that many people, including myself, think that what's going to get the Federal Reserve to cut rates, perhaps sooner than some think, is that it's not going to be because inflation is back to target. We know that the tariffs are going to boost inflation, even though it might not be filtered into this week's data. But instead, we're going to see a deterioration of the labor market. And again, the layoffs of the government, the immigration issue you were talking about previously, these are going to hurt the labor market. And though, again, it isn't showing up yet in the data, and this is sort of happens with a lag. And so I think that we should be looking for a sharper deterioration of the labor market in the coming months, which will prompt the Fed to cut interest rates. I think that part of the question is, how much will they cut by? And the market's pricing in almost 4 rate cuts this year, while the March dot plots, the March summary of economic projections by the Fed, only looked for 2.
Mark, how could the U.S. dollar stay the world's reserve currency when this administration's at war on trade with the rest of the world?
Yeah, I think that, it's not so much about the reserve status of the dollar. And because it's not so much about the dollar, the reserve status doesn't come from the dollar being a transactional vehicle. It comes from the role of the U.S. Treasury market as a store of savings. Not only, think about what's going on in the world. Many countries and companies borrow U.S. dollars. They're net short dollars. They got to pay them back. And I think that's more. Reserve managers haven't really expanded their reserve holdings, not only of dollars but of any currencies. And so, to me, it's not so much about the reserve status of the dollar. But I agree with, I think, where you might be heading, and that is that people, for a long time, people have questioned whether the dollar is going to stay as a reserve currency. I often show people this 1978 article in Business Week that raised the question. Back in 1978, people were doubting the dollar's role as a reserve currency. To me, there's 2 ways that the dollar really loses the status. One is by encroachment, someone taking over from us. China, Europe, some people even think the Bitcoin. But I suspect the biggest danger is not encroachment, but abdication.
All right, Mark, we got to leave it there. Thank you so much. And I want to mention to our audience that our executive editor, Brian Sozzi, is staying with me to continue to add his expert insights to our conversations throughout our programming. We're going to move over to Bitcoin now, because Bitcoin is rising today after President Trump signed a bill into law reversing Biden-era IRS rules that make decentralized finance platforms comply with the same tax rules as traditional brokers. The crypto market has been on a wild ride since President Trump won the presidential election, initially jumping to all-time highs, passing the $100,000 mark, and then falling along with the broader market as investors go risk off amid trade policy uncertainty. Our next guest correctly calling the current so-called crypto bear market. Here we've got Kamal Makedem. He is a general managing partner at Finality Capital, which is a venture capital firm investing in early stage companies primarily in the blockchain, IT and Web3 sectors as well. And before that, he also co-founded OmniX, a trading technology platform acquired by Gemini. I also want to mention our executive editor, Brian Sozzi, still here to add additional context. Now, Kamal, full disclosure for our audience, you're obviously a Bitcoin investor yourself, but you called this bear market. Talk to me about what you were foreseeing and how it's impacting your activity with crypto as an investor yourself.
Well, I've been trading crypto for a long time, since 2013. I started out with $500 and ended up with 50 million back in 2022. What we've seen recently is that I have a quant macro signal that gives me key inflection points in the market. It flipped from positive to negative coming into January, so I conclude the top would be around there. From the charts, you could see that You could narrow it down to the week that the top would come in sometime between January 13th and January 20th. The actual top was January 19th.
Come on, why hasn't Bitcoin why hasn't been seen, I guess, as a safe haven during these risk-off days for stocks? You go back in the past, and people would flock to Bitcoin. Well,
the number one driver of crypto prices is macro conditions, and macro conditions were tightening for whatever reason, and that's what's going to drive crypto prices more than anything.
And if that's what's going to drive crypto, then I guess I'm curious how you maintain investing in this digital currency in the environment that's so defined by uncertainty right now.
Yeah, I mean, that's why, our particular strategy is to take risk off at times when there's macro tightening and to put all that risk back on so that we can capture all the upside without suffering the downside volatility.
Okay, so then let's talk about this from the perspective of like a retail investor who has $10,000 to deploy in this environment. Do you think that they should be buying Bitcoin if they do have a longer time horizon?
Yeah, absolutely. I mean, this is a great time to buy. It'll probably be a little lower at the end of the year, but there's often divergences where, Bitcoin might be a little bit lower, but some of the alts that people might invest in might have already hit their lows early in the year. So you won't regret buying anything here 5 years from now.
All right, come on, we got to leave it there. Thank you so much for joining us. Appreciate it. Coming up, we're going to break down the week's stock market moves with a financial advisor who says now is a gut check moment. That's coming up next on Catalysts. U.S. markets taking wild swings this week as President Trump pulled back, and increased various protectionist trade policies. So how should investors handle the whipsaw action? I want to bring in John Shrewsbury, Gen Wealth Financial Advisors co-owner and managing principal for this week's FA Corner, brought to you by Capital Group. And still with us, our executive editor, Brian Sozzi, for the conversation. Great to speak with you, John. Talk to me about the single biggest question that you have been getting from clients amid all of this volatility and how you're responding.
Anytime volatility ramps up like this, the first question we're asked is, am I going to be okay? And the answer to that is yes, if you have a proper plan. Let's face it, this is a gut check. When you see markets roiling like they have on a roller coaster over the last few days, it'll get anybody's attention. But I think if you have planned ahead and you have proper diversification of your portfolio, the thing to do is to be sure that you go back and check that plan. Make sure all of the things, all of the assumptions that you made in the first place are still in place. And working with your advisor, you can, if you're needing income, you should have a cash pool available to you. If you are a long-term investor, then you just need to ride this out, because the volatility is something that is a price that you pay for the gains that equities can give you in the long run. And this is one of those roller coasters that we've seen. I think I saw a statistic from Yahoo Finance the other day that this pullback is not even ranked in the top 10 of all the pullbacks that we've had over time. And so I think, again, there's some perspective that's necessary on this. And if you've been a proper long-term investor, then you should just ride this out and see where we go from here.
John, if someone is retiring in a year, what are the top three things they need to be doing now? Mm-hmm.
Well, number one is they need to be sure that they have a strategic plan, not for the immediate necessarily, but for the long term. When you're retiring, one of the things you always want to have is a pool of cash that's available to pull from, where you don't have to liquidate anything. I have a common saying that it's not a bear market that kills your portfolio, it's selling things in a bear market that kills your portfolio. So when you design a retirement income plan, you want to have that pool of steady cash that's available for the next 1 to 3 years, and then slowly go up the food chain, so to speak, in terms of risk. We don't recommend that people invest in equities if they have a time horizon of anything less than 10 years. And so when we work with retirees, we're talking to them about investing in equities for when they're in their 70s and 80s to offset the effects of inflation and to give them growth in their portfolio, and not force them to liquidate anything in a market like this, because that's where the damage is actually done.
Let me just drill real quick deeper into that, John. Let's say they own, and I get these questions from folks on X, I get them right to my email box. If they are still nearing retirement a year and they own some NVIDIA stock, what do they do?
I think you diversify. I think you look at that and you go, okay, I probably still have some good gains, even though NVIDIA has pulled back significantly. I still have some good gains, and diversification is the key. We've been through this many, many times before, and when you have proper diversification in your portfolio, the roller coaster ride is much smoother. It's much less up and down and volatile. We think that clearly diversification is key, and investing in a single stock if you're moving into retirement is just the antithesis. It is not what you want to do. You want to be much more broadly diversified. Diversification has always been a tool that in the long run has worked well for retirees.
And John, I want to get your take on the consumer sentiment data crossing the wires this morning here. Year ahead inflation expectations hitting their highest level since 1981, and also respondents making unsolicited negative comments about government economic policy news hit a surged record. 60% of respondents adding negative commentary about the economic policies of this administration without being asked about it. What is your single biggest tip to those consumers who are concerned about both the economic policies and inflation going up?
I think you've got to have situational awareness, and what normally is happening in the stock market, it is like a roller coaster. But that roller coaster, for the most part, is set up on bedrock. The U.S. economy, the U.S. Cash flows, and the stability of the U.S. dollar, the stability of the treasuries, and all of that. Well, now we're seeing a situation where that bedrock is being shaken by an earthquake, and that earthquake is really what the administration has prompted with this trade war that we have now erupted into. So I think, again, you've got to think about this in terms of not panicking when things are volatile. We've been through the COVID crisis. We've been through the 1987 meltdown. I've been in this business a long time, and what I have found is that people who do the wrong thing at the wrong time for the wrong reason end up hurting themselves long term. I saw people that during the financial crisis went to cash and stayed there for a very, very long time, giving up a lot of returns. Oftentimes, the best thing that you can do for your portfolio is give it a good leaving alone. And I think this too shall pass. I think it was pointed out the other day that, we all think about things in the immediacy, but the fact is that President Trump is not going to be president for forever.
Right. All right, John, we got to leave it there. Thank you so much. And a huge thank to our executive editor, Brian Sozzi, for joining us for the hour. Coming up, we've got Wealth dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Keep it here.